Chubb just crushed their Q2 2026 earnings across the board. And what did Wall Street do? They slapped the stock with a highly cautious hold rating. The market seems totally fixated on this short-term, cyclical timeline, and honestly, by doing that, they are completely missing the real story of what is happening inside this company right now.
So let's unpack this valuation disconnect. Wall Street's biggest fear at the moment is a cyclical softening in commercial property rates. Analysts are absolutely terrified that dropping premium prices signal incoming trouble. But Chubb's reality looks vastly different. Instead of just riding the macro wave up and down, they operate like an elite compounding machine. They are literally using these exact cycles to protect their margins, reallocate capital, and outmaneuver less disciplined competitors.
Let's dive into why they are such a misunderstood compounding machine. To really grasp why the market is mispricing this, you have to understand how Chubb actually makes money. Think of them as a $66 billion systemic shock absorber for the global economy, operating across 54 countries. As you can see, their revenue generation architecture spans 6 distinct, highly specialized segments. We're talking about cyber risk for multinational corporations, multi-peril crop insurance for agribusinesses, and high-value auto and fine art for high-net-worth families. Look, they are not trying to be the cheapest option in the commoditized retail space. They win on bespoke risk structuring and the absolute fortress security of an AA-rated balance sheet.
Now, what's their true economic moat? It really comes down to one range, 500 to 700. Their core competitive advantage is an unrelenting, borderline obsessive underwriting discipline. Over any timeline you look at, 3, 5, 10, or even 20 years, Chubb consistently outperforms peer combined ratio averages by 500 to 700 basis points. And since the combined ratio measures claims and expenses against premiums, beating the industry average by that much for decades isn't luck. It's the result of highly proprietary risk controls.
And that discipline translates directly into massive intangible brand power. 92%. That is Chubb's account basis renewal retention rate in their North America high net worth personal lines. 9 out of 10 affluent families are sticking with Chubb year after year, even when cheaper alternatives are actively pitching them. In this niche, clients are paying for flawless claim execution, which creates this incredible structural barrier against low-cost competitors. The crucial thing to realize here is the sheer size of their runway. Even though Chubb is currently the largest publicly traded property and casualty insurer by market value, their $66 billion in gross premiums is a drop in the bucket compared to the total addressable market. We're talking about a global TAM projected to hit nearly $3.48 trillion by 2030. So Chubb currently captures about 1.1% of their market, leaving them with immense room to expand globally without ever saturating their core businesses. But that brings us to the core market conflict. This is the tension driving Wall Street's hesitation. Commercial insurance is notoriously cyclical, and with global commercial property pricing recently dropping 9%, analysts are bracing for a massive premium squeeze. But here's the genius of how CEO Evan Greenberg navigates a soft market. Instead of chasing unprofitable volume just to keep top-line revenue inflated, Chubb shifts into dynamic margin protection. They actively shrink their exposure in those soft property lines and aggressively pivot to capitalize on areas where pricing is robust, like North American commercial casualty, where rates just jumped 9.6%. And we have the Q2 2026 evidence to prove this strategy is working. If you want definitive proof of how well they execute, just look at their second quarter 2026 earnings reported on July 21, 2026. Wall Street estimated a core EPS of $6.78. Chubb blew past that with $7.26. Analysts projected $15.07 billion in total revenue. Chubb delivered $17.95 billion. Consolidated net premiums written climbed to $14.71 billion, and they tightened their combined ratio down to an incredible 83.8%. They grew the top line and improved underwriting profitability in a market that everyone warned was softening. And by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed. That earnings beat was so undeniable that it forced major analysts to rapidly scramble and adjust their models. KBW hiked their target from 374 to 389. Citizens JMP pushed theirs to 400, and JP Morgan adjusted up to 374. But here's the crazy part. Even as these individual analysts raised their price targets to reflect the massive beat, the broader market consensus stubbornly maintained that cautious hold rating. There is a very clear gap here between fundamental business performance and broader market sentiment. Now, before we look at the exact numbers on that valuation gap, I want to quickly mention that all of the research behind this video was created using Flash by StockSentinel.ai.
You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Okay, let's turn to the qualitative scorecard to check the actual health of the business. Synthesizing the qualitative metrics shows us if this growth is truly durable, and Chubb earns an elite blended quality score of 8.8 out of 10. Management alignment is a 9 out of 10, primarily because Evan Greenberg holds roughly $177 million in company stock, so he is highly motivated to compound value for long-term owners. Capital allocation and track record both hit a perfect 10 out of 10, driven by an amazing 33 consecutive years of dividend increases, plus a fresh $7.5 billion share buyback authorization. This is a company that generates immense cash and reliably returns it. So let's map this out in our 5-year scenario framework. Before we run the numbers on this compounding engine, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes through 2031. It is not a prediction, and it is absolutely not financial advice. The stock could go much higher or much lower than any of these scenarios. To build this out, we anchored on Chubb's historical 10.15% 5-year net premium growth rate. Then, we applied probability weights, a 55% likelihood to our base case, 25% to our high case, and a 20% weight to our low case. Let's walk through the operational assumptions here. In our low case, we assume a prolonged soft pricing cycle pushing the combined ratio up to 88.5%. But even in that downside scenario, using a modest 11.5x exit multiple, the implied future price is $390.41, still a positive 3.11% annualized return. Our base case assumes interest rates stay higher for longer, fueling investment income while underwriting discipline holds the combined ratio at 86%. At a 13.5x multiple, you get a $637.21 price, or a 13.28% annualized return. Now, our high case requires firm commercial pricing and new AI-driven operating efficiencies, pushing year 5 net premiums past $84 billion. If they command a 15x multiple for that execution, the implied price jumps to nearly $900, yielding a 21% annualized return. And remember, if you want to access the full model with all the detailed line item assumptions, you can check out the detailed research report at flash.stocksentinel.ai. When you apply our probability weights across those 3 scenarios, you arrive at a target of $652.65 over a 5-year horizon. Put that up against today's price of around $352, and the fact that the stock is currently trading at a highly modest 12.4x trailing PE multiple, the math here exposes a significant valuation gap. A gap that a market clinging to a hold rating seems totally blind to.
But no compounding machine is invincible, so let's talk about the major risks to watch.
We have to be honest about the concrete threats that could actually validate Wall Street's caution and derail this thesis. The most pressing company-specific risk is social inflation. We're seeing increasingly massive jury verdicts and expanded class action litigation, which could drive casualty payouts way beyond what Chubb has historically reserved for. Second is a prolonged market softening in commercial property. If pricing stays depressed for multiple years, their premium volume could contract meaningfully. Finally, macro rate sensitivity. If central banks cut rates aggressively, it's going to squeeze the reinvestment yields on Chubb's massive $175.4 billion investment portfolio. So how do you track that? Here is the exact early warning sign you need to monitor in their upcoming earnings reports: the North American Commercial Casualty Combined Ratio. If that specific metric begins to show a sequential, unexplained increase, that's your first major signal that social inflation is starting to crack Chubb's legendary underwriting discipline. So let's bring it all together for the final verdict.
We're looking at a business with a 500 to 700 basis point structural underwriting moat, a stellar Q2 earnings beat across the board, and a management team delivering a masterclass in protecting margins despite market softness. Yet, the market is so obsessed with a short-term cyclical blip in property lines that they are slapping a hold rating on a company purpose-built to compound capital over decades. The real question is, will Wall Street wake up to this reality before Chubb just buys back its own float at a discount? If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.